All right, let's get right into it. If you've glanced at any market chart lately, whether it's stocks, crypto, you name it, you've probably seen a whole lot of red. But the real question is, what on earth caused this massive sell-off? Today, we're going to cut through all that noise and figure out who or what is really to blame. I mean, it's the question on everyone's mind, right? One minute things seem, relatively calm, and the next it feels like the floor has dropped out from under everything. So, was this just one single event, or is there something much deeper going on behind the scenes? And make no mistake, this was not some isolated crypto thing. We saw Asian stock markets take their biggest hit in a month. We saw investors piling into safe haven currencies like the yen. Basically, the pain was felt everywhere, from the old school stock market all the way to the world of digital currencies. Now, whenever things go haywire, people immediately start looking for a simple villain, a single culprit. And the first one that hit all the headlines, you guessed it, the finger got pointed squarely at Bitcoin.
So this was the story that major outlets like Bloomberg were running with. The idea was pretty straightforward. Bitcoin, being this big, volatile asset, basically sneezed, and the rest of the financial world caught a massive cold. The argument was that its sharp drop created a wave of panic that just spilled over into everything else.
So how exactly did they connect these dots? Well, their case was that the crypto sell-off put direct pressure on stock markets. They pointed to those falling Asian indices and the classic flight to safety, where investors dump risky stuff and run to safer currencies. The big fear here was that investors who were using borrowed money, leveraged investors, would be forced to sell all their other assets to cover their crypto losses, creating this really dangerous domino effect.
And that really sets up the big debate perfectly. We have two competing theories. In theory one, Bitcoin is the initiator, the one that started all the chaos. But in theory two, Bitcoin is just a hostage, maybe one of the most visible victims of a much bigger, much scarier problem lurking just beneath the surface. And that brings us to that second theory. This one suggests that we should stop looking at crypto prices and start looking at the fundamental plumbing of the entire financial system itself.
Yeah, this counter-narrative actually comes from inside the system. We're talking about a lead trader at JP Morgan. Her analysis pointed to something way less obvious than a Bitcoin chart: major stress in what's called the repo market.
So what in the world is the repo market? Okay, think of it like the secret circulatory system for all of finance. It's where banks and big institutions lend massive amounts of cash to each other literally overnight. When there's not enough cash in that system, borrowing costs spike and credit just vanishes. It's a huge warning sign that the whole system is under some serious strain.
According to this JP Morgan analysis, here's the chain reaction that happened. First, you've got the US Treasury and the Federal Reserve doing something called quantitative tightening, which is just a fancy way of saying they're pulling money out of the economy. This basically acted like a giant vacuum, sucking cash out of the system. That created a cash shortage, forcing everyone to scramble for dollars. What do banks do then? They get nervous and start cutting off credit lines to hedge funds. And when the credit gets cut, you get forced selling, a fire sale. People start selling anything they can. Stocks, crypto, you name it, just to get their hands on cash.
So the takeaway here is absolutely crucial. From this perspective, the Bitcoin crash wasn't the cause of the plunge, it was a symptom. The real culprit was a fundamental lack of cash, a liquidity crisis that forced everybody to hit the sell button at the exact same time.
Okay, so keeping those two very different theories in mind, let's look at what the charts are telling us now, especially when it comes to Bitcoin.
This number, less than 30. For technical traders, this is a massive signal. It's Bitcoin's 14-day relative strength index, or RSI, and it tells a very specific story about just how intense the selling has been.
So in trader speak, an RSI below 30 means an asset is officially oversold. It suggests the price has fallen so hard and so fast that the selling pressure might just be running out of steam. Now, it's not a crystal ball, but it's often a sign that a bounce, or at least some stability, could be just around the corner. And if we look back, history gives us some pretty interesting context. The last time Bitcoin's RSI dropped this low was back in late February. That dip actually marked the beginning of the end for that downtrend, which eventually bottomed out before kicking off a huge rally to a new all-time high. Now, of course, history doesn't always repeat itself perfectly, but you can bet traders are watching this pattern very, very closely.
And look, this weakness wasn't just a Bitcoin story. An analysis from Matrixport on Ethereum showed a really similar vulnerability. It basically proved that by tracking the flow of money, like seeing a major buyer step away from the market, you could have seen these risks building up long before the price collapsed. It just goes to show, the real story is often much bigger than one single chart.
So, after looking at all this, what's the big lesson? What's the main takeaway from this whole chaotic episode? Well, it's actually a pretty simple but really powerful one.
It all boils down to these two competing stories. You've got the headline story, which blames the volatile crypto market and paints it as a danger to the financial system. But then you have the deeper story, which points to a serious liquidity shortage caused by monetary policy, suggesting that it's the plumbing of traditional finance itself that's creaking under the strain.
And I think ultimately this whole event is just a powerful reminder. When markets get this violent, the easiest explanation is usually the loudest one. But more often than not, the real cause is hidden one layer deeper, down in the complex mechanics that make money move around the globe. The real question for you is, which story do you think is closer to the truth?
If you found this explainer helpful, be sure to smash that like button and subscribe so you don't miss your next Daily Edge. More news in our Telegram channel in the first comment. See you next time.